To remain updated with the latest business news, click on the bell icon.
Presented by Ebix Cash. हर खुशी के लिए काफी है.
Hello and welcome to this post-budget market special from Business Today. I'm Udayan Mukherjee, and to talk about what the budget could do for the stock market and the bond market and indeed the economy, I have with me today Neelkanth Mishra of Credit Suisse. Neelkanth, thanks very much for joining in. We've spoke around the budget and you stressed repeatedly the importance of execution with this capex heavy growth plan that the government has unleashed. Does it still remain an area of concern for you? The fact that while outlay has been made for capex, the center and particularly the states may not be able to execute it to get the multiplier effect which the finance minister is talking about.
Absolutely. In fact, my fear is that so not only the capex outlays, which are about 2 trillion rupees extra, of which about 1 trillion or half of it, of the additional amount, is to be spent by the states. In addition to that, I think there is gross underestimation of revenues for both the fourth quarter of this financial year, as well as the estimates for the next financial year. And on the expenditure side, the targets for the fourth quarter are excessively high. So for example, government capex in the first 9 months is up 30%. In the final quarter is expected to be up 80% year on year. And for the next year as well, about half of the additional capex is to be spent by the states, on which we are relying on their ability to execute. The government cash balance, in my view, which was already 5.5 trillion when we last spoke, that was after the economic survey, I think the number could be closer to 7 trillion by the end of this financial year.
Now, this is disturbing, Neelkanth, and in your experience and analysis, what is the problem? I mean, are states able to do some kind of capex better than others? And the kind of capex which the finance minister is talking about, which is primarily infrastructure, which actually has a very good multiplier effect, is that the specific kind of capex which the states often are not able to deliver on?
No, I think states can do capex. It's just that it takes time to scale up. And a lot of that scale up is actually dependent on physical files moving, people coming to office, everyone being in office, everyone being motivated. And I think all of those challenges have plagued the response of the state governments in the last 2 years, that their processes are very physical file dependent. And unless everyone is in office, that can't work. It's illegal to take some files out of office. There are no tools to work from home. The automation of process flows, of documentation has actually not been done. Some of it deliberately. Some officials do not want the transparency, but some of it just because of the slow process of automation and adoption of computers. So work from home, which for you and me has worked more or less seamlessly, is not something that has been an option for state governments. But I think more importantly, the type of capex that the central government would like the states to work on is the more distributed kind. Right? So I think in principle, the decision to let states spend more is the right one, right? Because we need more capex on health, we need more capex on education, we need more capex on urban infrastructure, we need more primary healthcare centers, we need more rural roads, we need last mile power distribution. A lot of this is actually needs to be done by the state governments. The central government occasionally intervenes, like the Pradhan Mantri Awas Yojana, rural housing is a state subject. Rural electrification is a state subject. Rural roads are state subjects. But the center runs schemes. But there has been a lot of criticism that the CSS, the centrally sponsored schemes, are taking away a lot of the fiscal space of the states, because the center, allocates 50, 60, 70%, and the rest has to come from the states, and that they lose the discretion. So this making available of funds for the states to execute on is something which I think is a welcome move. but the concern that you raised, and I totally share, and I think it is actually a very serious one, is that they may not be able to scale up fast enough to drive the stimulus that the economy needs at this stage.
Right. In any case, Neelkanth, how influential is government capex? Because all of us get excited when we hear that government capex is going up 25%, 30%. But compared to the size of government capex as percentage of overall GDP and compared to private capex, do you think it really has the kind of firepower to galvanize a proper capex cycle in this country?
A very important question. So if you think through, so let's remove that 1 trillion rupees that the states have to send. It's more like a blank check, and we'll figure out how fast it is spent or on what it is spent. But if you see the increased allocations where we have some data, so there's about 15,000 crores, 150 billion rupees on the Nal Se Jal scheme. There is another 15,000 crores on defense capex. There is about 30,000 crores odd on roads and rail. Now, all of this is 60,000 crores, which is a lot of money, right? But remember that FY23 GDP is going to be 260 trillion rupees. So 0.6 trillion of capex is not really going to move the needle. So I think what the commentators are excited about or consider to be positive is that instead of targeting near-term growth, right? So one of the classic problems which theoreticians have been highlighting with governments is that the temptation to spend other people's money, right? That you because of the monopoly on violence, the state takes the taxes and then decides to spend as it wishes, and that wish is thankfully focused on long-term productivity building projects rather than just distributing the cash in subsidies or just cash handouts. And so the fact that the government sort of did not fall prey to those inclinations is something which is positive. The fact that it wants to spend productively is also very positive. On a macro level, though, and you're absolutely right, I think it is the processes, it is the aggregate end demand which actually will drive the private sector capex, which tends to be a lot higher in terms of a GFCF. So just to give you numbers, in gross fixed capital formation, so if the total number is say 26 or 27% of GDP, about 7.1, 7.2% of GDP used to be, this is a pre-COVID state, was the share of the governments, state plus center plus PSU. So about 1/4 of the total GFCF was driven by the governments. If this 7% goes to 8%, of course it is reasonable and substantial, but not substantial. But it is not enough to drive the private sector capex cycle. But the good thing is that the other two elements of GFCF, so there's a private corporate GFCF, household sector, which is the residual. So the private sector GFCF actually has held up. So I am surprised when I hear that private corporates are. If you see the government data, the CSO's data on GDP, you will find that private corporate investments, which are actually a data-driven thing, right? MCA 21 database, the 500,000 companies aggregate capex. So that number as a percentage of GDP is actually not slowed that much. The problem has been the household sector, where a lot of it was slowed down in dwelling construction. And so if we assume that the dwelling construction market is picking up, and I do believe that it is picking up, so there are very visible signs that we are starting a 3, 4, 5 year cycle. So then aggregate capex should be well supported. So there are many reasons why outside the budget, we should still be positive on investment activity.
So would it be a fair assumption? I mean, on the day of the budget, very simplistic assumptions are drawn because people are basically shooting off the cuff. So they hear capex and they say we should buy cement stocks and construction stocks because those will do well in the coming year. 1 week after the budget has been done and you've looked at the fine print as closely as you have, is it still a fair assumption to say anything to do with capex or construction should actually do well this year?
Well, cement and industrials and financials were sectors that we have been pushing now for several months. So it kind of supported our call. Though I agree with you that if half a trillion or say even 1 trillion extra rupees are spent by the government, it doesn't really move the needle on the aggregate number that much, right? Especially as quite a bit of that capex may not necessarily be about cement, and it may not necessarily be about capital goods that where the order flow is. If you see the order flows that are coming through for the capital goods companies in this quarter, right, in the December quarter, and this was well before the budget. The execution and the revenues are well tepid to in line, but the order flow is surprising on the upside, and that holds true for a whole range of capital goods companies. So I think capex has been surprising positively, and whether people bought it because of the budget, you're absolutely right. I think that just headline purchase, I think that may not have been appropriate, but even without that, I think there is visible momentum. In fact, on dwelling construction, I think that it can start adding to GDP from FY23 onwards, because last year, while real estate volumes picked up, sales picked up. As you know, sales are a wash in GDP, right? So if you have a ready-made apartment, you sell it out to someone, it doesn't really add much to GDP, only the brokerage amount is added. It is only when you start building new apartments, building new houses, you start launching new complexes, that's when the true GDP value add starts to happen. And that process, I think, will be kicking off now as the economy opens up again.
Where does this leave consumption, Neelkanth? Because, if there was one crib that a lot of people had after the budget, is that you are dialing back revenue expenditure, which is fine. But do you have concerns about whether demand will come back in the second half of the year quite so strongly, will follow through after the initial rebound trade is over? Do you worry about consumption demand, and does that color your judgment about how to approach discretionary and FMCG through FY22?
No, the short answer is no. I don't worry about it, in the sense that, see, there are many levers in terms of from here onwards that still have to play out, right? So, and the first and most important is that there are many low-income jobs that have still not come back. The schools are just starting off, and there are lakhs and lakhs of school teachers who used to earn 12,000-15,000 rupees a month, and where the school fees would be 300, 400, 200 rupees per month per student. Those schools have been shut for 2 years. The auto drivers, the rickshawalas who would ferry those kids to school, the uniform makers, the bag makers, the shoe makers, all these kids will need new shoes and new uniforms and all that. So all of that yet needs to happen. As offices restart, we are going to have office boys, receptionists, the dabbawalas, the food delivery. The other day on budget day, you need those fast internet connections and data sharing for responding to the budget documents. And the building, they were cribbing that for 2 years they've had no business. So I think as the economy opens up, you will see a new surge. And I think a lot of that will be low income consumption, because this will be, or say, travel and tourism. So Australia is now opening up for business. And I think the vice versa trade, the travel will also pick up. And just to give you things in perspective, $27 billion was the amount spent by foreign travelers, which is almost 1% of GDP, coming to India, and that had fallen to nearly zero. So there is a lot more that needs to happen, and almost all of that will be in low-income consumption, or the low-income earners, low-wage earners. Even the restart in construction activity. So October, November, I think November we saw a bit of a lull, but then since then, I think the incremental volumes are picking up. The incremental order flow activity levels are much better in January. And as the economy keeps opening up, I think you will see consumption revive. Some of the state government capex, which we earlier in our discussion were worried about stuff not happening. Remember that the governments and the people who are sitting in the governments do want to spend, right? Because it is in their interest as well to get that money spent. And so as that money hits the ground, you will see a lot more of construction activity. So if you plot the job losses from pre-pandemic levels to now, the job losses on the services side are in personal services, education, travel, and tourism. Other than that, I think everything is actually better. On the industry side, it is construction materials, so cement, tiles, bricks. It is also on equipment, which is the road equipment, the construction equipment, and on the auto side, which I think is supply driven. So hopefully that will get sorted out. So I think that the consumption improvement is likely to be more income driven, even if the government had given $500 billion, 1 trillion rupees more. And remember that what we see as a reduction in subsidy, I think the deliberate reduction in subsidy is only the PMGKY, right? The Pradhan Mantri Garib Kalyan Anna Yojana, that free grain scheme. The Narega the allocation decline is more an assumption that there will be low demand. If there's more demand, I think they'll have to increase allocation. The reduction in fertilizer subsidy is again an assumption that fertilizer prices globally will come off as energy prices come off sometime in the middle of the year. And that's the assumption, right? So if those assumptions are not met, then that expenditure goes up. So what even if the government had spent $500 billion more, actually the incremental impact on consumption may not have been that substantial. It is much better and much more prudent to actually open up the economy, and then the income starts flowing, and the impact of that on consumption, where people become more comfortable with their future earnings as well, is going to be far more substantial. So I don't worry about it. Last point on discretionary versus staples. See, I think the discretionary demand improvement, quite a bit has actually already happened, in the sense that in the segments that we deal with in the stock markets, the consumption numbers are already reflecting, because the top 30% of the population did not really see that big a decline in their income and their consumption. So that level has already normalized. And what we are likely to see now is the improved consumption from the bottom 50%. And only staples and telecom among the listed sectors have that deeper penetration. Because even two-wheelers, only top 40% of India's households can afford two-wheelers. And that's also somewhat a balance sheet item, in the sense that till their wealth effect has recovered from the 2 years of losses, it is very hard to see two-wheeler demand coming off, growing from here. So on two-wheelers and discretionary in general, we're actually underweight. And we think staples would be the place to be as the economy opens up.
Okay. Now, the one area of concern on the day of the budget was the bond market, where yields shot up quite a bit. And one often sees the next day the reaction being moderated, but we did not see a great moderation. Maybe it's because of the higher than expected borrowing calendar of the government, or it could be something else. But do you worry that there is going to be a sticky kind of a hardening of yields, which may make things difficult this year round?
Well, I totally worry about it. The good thing about our current bond market dynamics is that a very small percent, 1-2%, is owned by foreigners, right? So if the government is paying more, there are people who are earning high yield, right? So it's more a transfer than a cost. And but what it does do is it restrains the government, and it also benchmarks rates higher, right? So there are many banks where the lending rates are earmarked to the GSEC yield. There are of course, if the government is borrowing at 6.97%, then everything else gets marked up, and that's a risk. And I think premature tightening of monetary conditions is a big risk for us, because the economy is just starting to heal, and here we have the term premium going to 2.9%. Now, why has that happened? I think it just reflects a lack of depth in our bond markets, because I'm an equities person. My mandate is mostly, and I've been looking at equities for a lot longer than I've been looking at bonds. So perhaps the bond market is seeing something that I don't see. But the way I look at it, it is that the government is eschewing, it is refraining from doing wasteful spending. It has managed to raise its tax to GDP. If you see the debt to GDP going up, right? So FY20 debt to GDP, that state to center, was 75%. Right now, the government is at 87%. If you take government estimates for next year's GDP and fiscal deficit targets and all of that. But if you adjust for the fact that there could be quite a bit of cash left over at the end of this year, and next year's assumptions are perhaps too low, and the fact that nominal GDP growth could be 13%, that 87 becomes 81. And when you see that 6% rise, why it has happened, 3% of that could be capex. Now, if the government is spending and spending prudently, it is actually showing up on the ground in terms of better roads and drinking water and pipe drinking water for people, and quite a bit of that is just cleaning up of the balance sheet, right? So the government has decided to bring on budget what used to be off budget, and it has decided to clear its arrears, right? So export incentives on fertilizer subsidy arrears. So this is just a change of name. So instead of NHAI borrowing, it is the government borrowing. And therefore, from a crowding out perspective, I suspect that the bond market is overreacting. And in fact, what this suggests is actually a plumbing problem rather than a gross savings problem. So even on the day of the budget, we highlighted to investors that the net borrowing by the government as a percentage of incremental deposits has actually not gone up that much. Because remember that the nominal GDP is now within 6% of its pre-pandemic path, right? So because with the 18% growth in FY22, without it would have been at, so if nominal GDP was 100 in FY20, FY22 without the pandemic would have been 123. With a 1.5% decline in FY21 and an 18% growth in FY22, that has become 116. So it's only 6% below. And therefore, the tax to GDP and a lot of the assumptions are actually far healthier than what the bond market has been looking at. And savings have actually gone up in line with the nominal GDP as well. Perhaps, in fact, as a percentage of GDP, they've gone up. So I don't see this as a crowding out problem. I think this is primarily a plumbing problem, that it's at the base of it, at the core of it, it's an illiquid market. There are few opinion makers who set it, and once the momentum goes against you, then the bond yield says, because everyone just refuses to buy. And I think as clarity emerges, as the government itself figures out, perhaps when it's setting up the second half borrowing calendar, that both states and center do not need to borrow that much, I think this problem of excessively high bond yields too early in the cycle will be solved.
Okay, let's set the budget aside for a minute, Neelkanth, and let me ask you about how you feel about the markets in the global context this year. Because the year has started on a rocky note. We can see turbulence in the American market very clearly, largely in the technology space. Do you think this year we might see severe headwinds from the global space, which will become much more important than the economic cycle that we're seeing in India? Or do you see the market differently?
No, absolutely. In fact, I couldn't agree more. In fact, what we are seeing now, when the lockdowns were on, the policymakers had to decide on the fly how big a stimulus they had to give, right? So they had to figure out, is $500 billion enough? Is $1 trillion enough? I'm talking about the US, of course. Is 1.5, 2 trillion enough? How much should you print? Should it be 60 billion a month? Should it be 200 billion a month? Should it be 500 billion a month? And now that we can see the pandemic in the rearview mirror, and touch wood for that, it is time to calibrate whether the responses were appropriate. And what we see now is that there is a lot of money in the overnight bank markets, not just in India, where, of course, a lot of it was created by the surplus dollars coming in, the balance of payment surplus, which the RBI had to neutralize. But even in the US and in Europe, so in the US, there's now $1.8, $1.9 trillion overnight, which the banks are parking back to the Federal Reserve, which means that this is excess money. Same in Europe. So they already had a big surplus, but that number shot up further to $4 trillion. Japan has been at 4.5 for a while. So this suggests that the monetary action was excessive. For almost for many years, I would say, we have forgotten, or at least the markets have forgotten, that high leverage and high interest cost burdens can lead to bankruptcies. And these are questions that have not been asked for quite a while. And now you see, after a long time, that the double B bond yields are starting to go up, and the bond markets are starting to price in some risk. At the same time, on the fiscal side, the US, retail sales went to 7, 8, 10 standard deviations above normal, which means statistically they shouldn't have happened. And so when you see that large a stimulus, and of course now that they're worrying about inflation, they're very clear that even if growth signs are weaker, and clearly with the Jan employment data, they have another month at least of retaining that hawkish stance. It is very clear that the primary target for policy now is inflation. It's not growth. And as the world recalibrates to that, I think you should expect a lot more of choppiness. And remember that outside of the US, the end demand trends are actually quite weak. So as the US has been falling back to trend in terms of retail sales, the aggregate global retail sales, so we run a proxy, and we had expected that it would fall below trend by March. It seems to have fallen below trend in December itself. So there'll be some incremental positives coming from as the economy is open post-Omicron, but I think the underlying demand trends are very weak, and I really worry about that. And I don't think the markets are fully pricing in the disruption in end demand, the concerns of what weak end demand can do to the financial system, in the sense that there would be junk bonds which will go under. There will be several concerns. And lastly, if you see oil prices, so while I'm reasonably comfortable that a supply response will occur in most metals, on oil I'm worried that the supply response may be constrained either by geopolitics or by the shale companies being cash rich but refusing to invest in fresh rigs or new drills. And what this means is that there is a lot of transfer from the oil producers, or from the oil consumers to the oil producers as oil prices go up. And because the oil producing nations, the surpluses are concentrated in a few nations, it actually becomes a drag on overall growth. So lower oil prices are good for global growth, and higher oil prices, especially when supply is the constraint, are actually bad for global growth. And I think all of these concerns will become front and center over the next few months, and I expect a lot of choppiness in global markets. That should worry us, particularly given that the price to earnings premium that India is trading at right now is close to its highest levels, right? So the PE premium, the range used to be -5 to 35. We were at 38 in September, and then we saw a bit of a correction to 21, 22. And because in January, the global markets fell a lot more than we did, that number went up to 33% again. So given how stretched the PE multiples premium is, if the global markets are volatile, I think we'll be volatile as well.
Neelkanth, we'll leave it there. Always a pleasure hearing your thoughts. Thank you very much for your time today.
Thank you.
If you like the video, do like, comment, share and subscribe.